Hello, and welcome to the second part of Chapter 3, 3B. We're here completing now the accounting cycle. So, we're going to get through the last part of the cycle, which is known as the closing part. Now, as I mentioned before, certain statements are period statements, periodic. So, they only survive for that year, the month, however we want to do the closing process. This is only going to affect 3 of our classification of accounts. Really good old-fashioned dealer. Well, this is going to focus on the revenue, expenses, and dividend accounts when they're pertaining to retained earnings. We're going to really basically accomplish this in 4 journal entries. This is why, if you heard on Chapter 3, the first part, was that I said that closing is going to be a little bit easier. Well, it kind of is. The only problem is to actually know the process and know how these accounts are affected. So, with that, we're going to go through the process of the 4 journal entries and how we close out the accounting cycle. So first off, if you remember from the previous video, here was our adjusted trial balance. Again, let me minimize this a little bit. As you see, a little bit more. Woo, there we go. Right here, we have our unadjusted trial balance, what we started off with, our adjusting entries, and now again our adjusted trial balance once we've added the adjusted entries to the amounts of the unadjusted. We are going to focus in basically from 319 to 690. All of these accounts are going to disappear. They're no longer going to be here after we've closed everything out. So, in order to do this, we're going to get into with the first account, which is revenues. But I like this little note here. Accounts that are going to be closed out, they have another term to them, which is known as temporary accounts. These accounts are only there for the year that we're questioning, so for the fiscal year. The accounts that are not closed out are permanent accounts. So, if ever you hear temporary, just think of dividends, revenue, expenses. If you ever hear permanent, your assets, liabilities, and equity accounts. So here's the steps right here. First step, like I said, we're going to close out the revenue accounts. Second step, we close out the expense accounts. Third, we're going to close out a new account called income summary. And fourth is closing out dividends. Always do it in this pattern will help you out the best way of doing closing entries. So the first one we close out is our revenue accounts to a new account called income summary. Now, there is certain things going on with income summary. This account is new to us and it only appears during the closing process. Okay, so this is not an adjusting entry when we adjust, it's only during closing. And basically, this account's going to be your net income account or net loss account, depending which way it goes. So when we close out this account, we're going to look at our revenues. Again, Connect likes debits before credits. Well, when we close out an account, it just means we're bringing it down to 0. So if you look up here, we're going to look at the unadjusted, and we're going to find our revenue accounts. We actually have 2. We have consulting and rental. Notice right here, if we properly do our trial balance, adjusted one, notice that they're both credits. and we have to bring them down to 0. So when we're bringing the accounts down, we have to do the opposite. So if they're credits now, the opposite would have to be a debit. So we're going to debit for those amounts. So when we do the journal entry, oh, I love it. Here we go. So when we do the journal entry, we have the consulting revenue and rental revenue both being debited. Notice that our new account, income summary itself, is now credited. So just like in our income statement, if you want to look at that too, this should be your total revenue in your income statement if we actually have one. But our revenues is always going to be the opposite. So thinking about expenses is going to do the same thing. They are normally debited, as we can see up here. They are normally debited. So if we're closing them down and bringing them down to 0, we must credit. So again, we're bringing them down to 0, so we're closing them out. But since expenses get credited, we must debit income summary. Again, notice that we don't just go expenses and it's the total amount. You have to list each expense account. Again, all this is basically tracing. We like to trace. So we have to see where the journal entries go. And remember, also, each of these accounts have their own ledger, their own T accounts, and so forth and so on. And I don't know what happened to my insurance expense, so let's correct that. Insurance expense was a grand total of 100. Somehow that got messed up. There we go. In fact, insurance expense is in there twice. Get rid of that. But again, we just list them out. So, again, once these two closing entries are done, income summary is going to basically have the balance of our net income, our net loss. Whoa, and that just goes flying off. There we go. Now, so with that being said, a T-chart is the best thing. If you remember how to do those, just draw yourself a little T, put your credit of 8,150 on one side, debit on the other, or just basically subtract the two. If this side, if the credit of income summary is greater than the debit side, then that means we had a net income. If the debit side is greater than the credit, it means we had a net loss. So for businesses, we would love to have a credit side with an income summary, which again means net income, means we made money. And we love making money, just like Mr. Krabs. Money, 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 money. So once we subtracted the two, we actually find out that we have revenue of $3,485. Now we move to step 3. Step 3, we're basically going to take the difference of income summary. It's right now has a credit because again, looking up here, it was larger. So of course it still got a credit amount. And we're going to basically close out income summary to retain earnings. So since it's credit right now, to close it out to bring it to 0, we must actually put it as a debit. And then we take retained earnings and credit for the amount. So again, it shows in our retained earnings that we made a profit for that year. Yay! But that's not the last part. And again, right here in the note, if there's a net loss, income summary will be a debit. We'll start out with debit. Thus, we need to credit the account. So in series, this will be flipped. Retained earnings will be the debit account, income summary will be the credit account. But I will already warn you right here, with any problem that we have, I highly doubt that you're going to have that. One, keep with net incomes. Net losses won't happen too much. So our last step of closing is we have to close out the dividends. Now, if you remember your statement of retained earnings, this is actually what's being done. If you look at the income summary, the statement of retained earnings, remember we take the beginning retained earning balance, add in net income, which is technically our income summary that is being added in because retained earnings is a natural credit account. It only increases by credits. And then we subtract out dividends, which this is now the journal entry to subtract out dividends to end up with our ending retained earnings. So, with that being said, again, dividends is going down to 0. So this one we can again look up to our trial balance, or unadjusted for the amount. And there's dividends. We find out there's 200. That's debited. We must credit it to get down to 0. And then we, of course, debit retained earnings. Again, debits before credits, especially when you're dealing with Connect. So retained earnings is going to be our first one since it's being debited, and dividends gets credited. And that's our closing cycle. So for our 4 steps, boom, right there. In fact, here's a nice little summary of what's going on. So if you look at here, here's our T-chart for income summary. There's our credit of $8,150, which basically comes from closing out revenue of the 2 debit accounts right there. So we had debit them, makes our credit. Then we take our expenses. We credit each one of those to make them down to 0. That's our debit and income summary. The difference between these two is our balance of $3,785. Again, you must find the balance of income summary before you move on after you've done the first 2 steps. From there, we take that amount in income summary. Be it credit, we have to debit it. If it's a debit, we have to credit. But we take that amount and it goes to retained earnings as basically the opposite of wherever income summary is. Again, using our example, it's a net income, so it's credit retained earnings, debit income summary. Then we take dividends and close that out. So from there, this is like the separate item as it's not really containing to the first 3 accounts that we use. But of course, that journal entry is always going to be a credit to dividends, debit to retained earnings. And boom, we come out to our ending retained earnings. Since this company just started this year, doesn't have any beginning retained earnings, so whatever we do to close everything out is basically its balance at the end. So once we do that, once we close them out, we have what is known as the post-closing trial balance right here. Let's zoom into this. Okay, the post-closing balance. If you notice, there is no more revenues, there's no more dividends. Again, everything after retained earnings is basically gone. So even if there's common stock and there was no retained earnings account in our adjusted trial balance, we add in retained earnings and the ending balance for basically what we come out with. So again, we have basically all of our accounts that are related to our balance sheet here. And that includes the cash, the receivable, supplies, prepaid insurance, equipment, the accumulated depreciation, accounts payable, salaries, unearned common stock or retained earnings. Now, if you can see, again, they should balance. And they're going to be roughly the same as your balance sheet. The only difference is this accumulated depreciation. Since it's actually a credit on the trial balance, it's going to raise this side by 300, lower this side, or about 600. But that's going to be the only difference. So if everything else is matching up, it should match your balance sheet to a T to the amounts that are in the balance sheet. Okay? But anything during the closing trial balance, if it's 0, it does not show. And that's only going to be dividends, revenue, and expenses. Now the next part that you got here is something that we're going to be going into as we progress throughout the later chapters. And this is known as a classified balance sheet. Quickly over this, current assets and current liabilities are basically classified as anything that will be under a year that we're going to either get rid of, or basically used within the year if it's an asset, and with current liabilities, it's anything that we're going to pay off within a year. So for current assets, normally this is big one is cash, accounts receivable, and any inventory, supplies, adjusting entries tend to be more showing in current assets, while current liabilities like credit cards, accounts payable, anything that again we pay off within a year. Non-current assets are basically anything that's over a year. So again, long-term investments, if I invest into a company itself, that would be a long-term investment. Plan assets, fixed assets basically, and intangible assets. These are assets I can't really physically touch, like trademarks and patents and those kind of things, copyrights. On the other hand, you have non-current liabilities. Again, these are liabilities greater than a year. So your long-term loans, your basically long-term loans. There's not a lot more that classifies as non-current liabilities, but there are, as you progress and determine to the company itself, you will have quite different long terms. Shareholders' loans or liabilities, those can figure into that too. But that again determines by the company. Equity, of course, is stuff owed to the owner. So, yay on that. So right here is our actual, basically, I know this is chapter 1 through 4, but this is 1 through 3 summary. So our accounting cycle itself is now complete. So just like the circle of life. If that song gets stuck in your head, it's a great song. But the accounting cycle has its own circle that it goes through. And we just completed it. So, yay! Round of applause. You now finish the first 3 chapters and the first basically major 3 chapters. So, with the accounting cycle, just to summarize, we start off with analyzing the transactions. So what you've been doing for each of the problems that you've had. We tell you that this happens for this reason. So we paid cash for supplies, or supplies on credit, or any other of those. Then we went to journalizing, which basically means making the journal entries, posting them in our T-charts and our general ledger, to preparing the unadjusted trial balance, Next, we move to the adjusting entries. So, Chapter 1 and Chapter 2 was basically 1 through 4. 5 is starting out the beginning of Chapter 3, Part 1. So we made our adjustment entries. We prepared our adjusted trial balance. Then we move to what is basically preparing our statements. So 7 is preparing the income statement, balance sheet, and statement of retained earnings, and statement of cash flows, which again were introduced in Chapter 1. We are going to get into more of those as we progress through the chapters themselves. Step 8 is all about closing entries. So closing them up, knowing the 4 journal entries that we have. 9 is preparing the post-closing trial balance, which you just saw. And then 10 is an optional one, but tends to happen when we reverse at the beginning of next fiscal year. As you saw, I showed you one in part 1 with salaries. We will have other reverse entries, but that's more of an intermediate accounting topic, not for principles of 2301. So no worries about reversing. Yay! So there's the accounting cycle. Again, this is completely the way that we work, and we're going to basically get through these as the process goes on and on during the semester or during the class. So again, we're going to leave you off with one last more ratio. So lots of ratios. Now we just talked about the classifications. Here we actually have use of the classifications known as the current ratios. Now the current ratio basically says, are we going to be able to pay our debts in the near future? Can we pay what we currently owe in less than a year to our current assets? Investors again look at this as, is the company doing well enough to stay ahead of its liabilities? If we're looking at the beginning of a company, this ratio is not going to be great because again, they're basically trying to buy. They may have more liabilities than what the assets are, and namely probably because of cash. But as this progresses, you should see a flip. Assets should outweigh liabilities, and we should see anything above a 1. Okay? If it's above a 1, that's great. That means we can pay off all of our liabilities and still have money. If it's under 1, we may want to watch out that company. The company's not doing so well. Because it says that basically if they go bankrupt, belly up, they can't pay whoever they owe currently. So if you're an investor and you're going to lend the money and they have below a 1 and they've probably been around for 5-10 years, you probably want to say no. Okay. So again, this one, we're going to take our current assets. Again, that's cash, inventory, salary, supplies, accounts receivable, anything that we're going to get rid of within the year, and divide by current liabilities. So credit cards, accounts payable, salaries payable, because we're probably going to expect to pay our employees within the year, because I doubt any employee is going to work for more than a year and not get paid, and so forth and so on. So this ratio, we're going to deal with that. As you can see again with our example with limited brands, we take their current liabilities, current assets, divide the 2. Notice that in 2010, they were really good. Probably had a lot more cash than liabilities. And so it was about 2.5, which is good. Then it goes to 1.7, 1.6. And notice again, they're following kind of along the industry current ratio average this time around, and that's pretty good. That means that they're right on target. With 2010, I would actually question because they're a little bit high. They probably didn't use the cash enough. They have a little bit too much cash. But as you can see, they were able to kind of judge it. And this again is questions we ask as accountants. Do we see something that's a little bit odd? Maybe we should look more into it. And if you're an accountant major, that's the mindset you want to get into. That logical, does this make sense mindset. But that is basically it for chapter 3. Notice that we don't have an actual problem with the notes. So really, I would suggest to check out the homework video to see more problems that deal with the actual journal entries. Again, there's only really 4 that we worry about, and just this current ratio for closing entries. Okay? Well, I will see y'all with the next video.